Hey guys, welcome to my channel Accounts Accuracy. Let us read the fourth part of our ratio analysis, that is activity ratio. In this video, we will study about activity ratio. You must know activity ratio is what? It tells us about the performance of a company, or you may say how well the activity has been performed by the company. Here, performance ratio means it measures how well the resources of the enterprise have been used in business. You can see here any businessman will never desire to keep its inventory for longer period of time. All entrepreneurs wish to convert it into sales. If they will not convert into sale and keep it idle, then they will not be able to earn profit. So it is very essential that they should convert it as quickly as possible into sale. So that is why the performance ratio is measured. So you must know that activity ratio is also called as efficiency ratio or performance ratio. Higher the turnover ratio means better use of resources, which in turn means better profitability. Now you must see that activity ratio are of four types. The first one is trade receivable turnover ratio, trade payable turnover ratio, working capital turnover ratio, and inventory turnover ratio. As I told you, its entrepreneur's main aim is to turn inventory quickly into sale, because as quickly as the inventory will be sold, they will start earning the profit. Now these are the formulas of activity ratio. We are going to discuss each of these along with the sums. Let's start with inventory turnover ratio. The formula for inventory turnover ratio is cost of revenue from operations or cost of goods sold by average inventory. So you have to remember that whenever you are going to calculate any of these formulas, everywhere you will have to remember that actual price divided by the average will give you that particular turnover ratio. Everywhere you have to divide with the average. Average means opening plus closing by 2. Now here the inventory turnover ratio will be calculated by first of all finding out cost of goods sold. You must know what is cost of goods sold. I think you very well know what is trading account, because for calculating gross profit, companies used to deduct from its sale all the direct expenses as well as opening stock and purchase. So here you have to calculate cost, means how much expense the company has done, how much company has invested in making its product. Now you know that opening stock remains every year with the company. Along with that, some purchases of raw materials are done and some direct expenses are made. Wages are the direct expense, or few other direct expenses remain. So these all three are added, and from that you deduct the closing stock in order to find out your cost of goods sold. Here you can see in trading account also we were doing the same thing. Opening stock plus purchases plus direct expenses. From these three, when you deduct closing stock, you get the value of cost of goods sold. Remember, with the entire opening stock, you add net purchases and add direct expenses, then you deduct closing stock, which gives you cost of goods sold. You can also calculate it by net sales. If your net sales is here at the credit side, from that if you will deduct your gross profit, you would easily be able to get your cost of goods sold. This formula can either be calculated by using the opening stock plus net purchases plus direct expense minus closing stock, or you may calculate it if you are provided with revenue from operations. From that you may deduct your gross profit. This is the another formula which could be applied, but this generally doesn't come in exam. And for average inventory, you know, from opening inventory plus closing inventory by 2, you have to find out the average of opening and closing. So once you know the formula, it becomes very easy for you to calculate inventory turnover ratio. So now what we have to do, we have to calculate inventory turnover ratio here. Cost of revenue from operations is 4,50,000, which is given, and with that what you have to do, you have to find out the average inventory. So this average inventory would be opening plus closing by 2, that we have done here, and you will get 1,12,500. Once you find out the average inventory, you divide cost of goods sold by average inventory, you get your inventory turnover ratio, that is 4 times. And that you know that inventory turnover ratio or any turnover ratio comes in time. Now next let's see what is trade receivable turnover ratio. The formula for trade receivable turnover ratio is credit revenue from operations by average trade receivables. Average trade receivables, again, that will be opening trade receivables plus closing trade receivables by 2. Here are all the informations regarding your credit revenue is provided, that is total sales of the year is 1,75,000, cash sales is 20% of total sales and sales return is 10,000 and opening plus closing balance of trade receivables are accordingly provided. Now let us see how to calculate trade receivables turnover ratio. For calculating trade receivable turnover ratio, the formula is credit revenue from operations by average trade receivables. Now here your credit revenue from operations is 1,30,000. This we have calculated here. How? By from total sales we have deducted cash sales and sales return. Here the cash sale value was given 20% of total sales, that is 20% of 1,75,000, that would come here 35,000. So once you deduct cash sales from total sales and sales return of total credit sale is 10,000. So only 1,30,000 will be left as credit sale which has not been paid. Now this 1,30,000 is the value of credit sale. Average trade receivables could be calculated just by adding both opening and closing balance of trade receivables and dividing by 2. It would come 10,000. That would be divided here in order to get 13 times, that is trade receivables turnover ratio. Same way you can also calculate trade payable turnover ratio. From the entire credit sale you will divide with the average trade payables and you will get the value of trade payables turnover ratio. In the sum you can see here credit purchase during the year, that is 6 lakh is provided, and the opening date it is given 1,44,000 and closing balance, that is 96,000 is provided. So once you will add these two and divide with 2, you will get the average value of trade payables. So that 6 lakh divided by average trade payable, you will get the value of trade payable turnover ratio, that is 5 times. And the last one is your working capital turnover ratio. For this what we do, revenue from operations divided by working cap. Revenue from operations would be what? The total sales less sales return. So total sales value is given here, that is 3,50,000. From that if you deduct sales return you get revenue from operations. So 30 lakh is the revenue from operations. And working capital, you know very well, the actual value of capital which is invested by the entrepreneur. From current assets, once you deduct the current liabilities, you get the working capital of the company. So 9 lakh was your current assets. From that you deducted the current liabilities, that is 6 lakh is the value of working capital. 30 lakh by 6 lakh will give us the value of working capital, that is 5 times. So this is how we calculate turnover ratio. I hope the video might have helped you in understanding all 4 types of turnover ratios. If you like my video, don't forget to subscribe my channel and do hit the big fat like button. Thanks for watching.